Okay, so this is your Chapter 12 handout on adjusting entries. And so here's going to be number one. I'm going to walk you through how to do the calculations, and then I'll take you over to the journal to show you the actual journal entry. All right, so let's get started. So number one, this is a bad debts expense adjustment. And so what we'll want to do is I'm just going to jump into the second sentence. I'm looking for the 560. That's going to be your net credit sales, and 1.4% of those are going to be uncollectible. So all you have to do is take 560, let me write that out on your calculator, and multiply that by 0.014. And when you do that, that's going to give you an estimate right around 7,840. So once you do that, all you have to do is figure out now next what accounts to debit and credit. And I've already done that for you. Let me go back up. So on this one, just to kind of show you, I went ahead and debited your uncollectible accounts expense for 740. That's right there. And then I credited the allowance for bad debts. That's an allowance account. That's a contra asset for 7840. And then that's all you do. All right, now let's go to the second one. All right, so on this one, this is going to be another review problem from Chapter 5. This is your depreciation expense. And so let me kind of map out how to do the calculation on your straight line method. The equipment that they purchased costs $65,000. That's our cost, so I'll have $65,000. They give you a salvage value of $3,800. And then I got to figure out what to divide by. So the problem says 6 years. But this problem says you bought the thing on January 3rd and they want the adjustment at the end of January. So this is a 1-month adjustment. So you might just want to divide by 72 months directly, and that'll give you your per month allocation for expense. And if you do that, that'll get you right at 850. All right, so once you've done that, then I'll go back to the journal. And as you notice I debited depreciation expense for 850, and I credited accumulated depreciation just like we did back in Chapter 5 for the 850. There you go. All right, so let's go to the third one. Page down. All right, so actually let's do 3 and 4 together because both of these represent interest calculations, and then I'll go and look at the journal once we've done the calculations first. So both of these are going to be your principal times rate times time calculation. So specifically on number 3, our principal on the note is $6,000. So I'll just to remind you, PRT, that's what we want to follow. So we're going to have $6,000 as principal. Our interest rate is 9%. So remember, I always take that and divide by 12 to convert it to a per month interest rate. And then our time period here is going to be November 1st through December 31st. So that's going to be 2 months. So multiply this by 2. So when you do that, you're going to get right at $9 of interest that we owe for 2 months. That's number 3. Number 4, same deal, PRT. The principal is $12,000. The interest rate is, it looks like it's 8%. So I would take 0.08 over 12. And our time period in this one, since it was issued on December and they want the end of December, the time period is simply going to be 1 month. When you do that, you're going to get right at $80. All right, now, so once you've done that, let's go back and look at the journal entries. And just to kind of highlight both of these, I'll circle both of them because I've already typed them up for you. So notice the account names are the same. Debit interest expense, credit interest payable, debit interest expense, credit interest payable. Those are the same. And then, of course, you can see that the amounts, simply like we just calculated, are 90 and 80. That's all you got to do. All right, so that takes care of the interest one. So now let's go back and we'll do an insurance adjustment. That's number 5. So number 5, it looks like the premium costs $5,640. It's a 1-year policy. This was done on August 1st. So to get my calculation, I take the 5640 divided by 12 to convert it to per month. And then, of course, just to remind you, August 1st through December 31st would be right at 5 months. So if you multiply this by 5, that's going to give you $2,350. Just pretty much almost identical to what we did back in Chapter 5. So then if we go to the journal entry, you notice we've got insurance expense, here's my debit, and then we've got prepaid credit, and then there's my credit as well. All righty, so let me clear that, and then we got one more to go. So the last one. All right, so the last one is an unearned revenue adjustment. It said that, I'll just jump right here. It says they received $6,000 in fees in advance. They put this in their liability account. And then this 2,000 represents, again, what they have earned. So no calculations really, because they told you the amount. All you have to do is enter the correct entry. So let's go down here and you'll notice you would debit your unearned revenue for the 2,000, and then you're going to credit your service revenue for 2,000, and that would take care of it.